right, well, good afternoon. Thank you for joining us here at FactRight for a webinar related to COVID-19 developments and impacts to alternative investment programs. First, let me introduce myself. My name is Jacob Heidkamp. I'm a manager here at FactRight. What I'd like to do here today is provide you with a brief backdrop on some COVID-19 related developments and specifically how these are presently impacting alternative investment programs in the non-traded REIT and BDC space. As we all know, there have been significant shelter-in-place orders across many states. This map, courtesy of the New York Times, highlights shelter-in-place orders at the peak of the shutdown in late April. As we enter into May, there are many states that are beginning to ease up on these restrictions, highlighted in the second map here. This begins to provide a backdrop for many consumer-facing and non-essential businesses to begin operations again. This bodes well for commercial real estate landlords, including REITs, and creditors, including BDCs. The sooner business picks up, the sooner rent and interest payments that may have been deferred can resume. What remains to be seen is to what extent and for how long consumer behaviors have changed in light of the shelter-in-place orders, and if there are any second waves of the COVID-19 disease that result in additional lockdowns, which would obviously have adverse impacts to the economic environment. The shutdown has had traumatic effects on unemployment. As this chart highlights, unemployment claims have spiked to a cumulative 30 million in the last 6 weeks. For a little bit more historical perspective, you can see what looks like a relatively minor road bump right before 2010, which was the great financial crisis of 2008 and 2009. Is kind of dwarfed by the wall of unemployment claims that have followed the shelter-in-place orders related to the COVID-19 outbreak. This economic dislocation has been met with very strong policy responses from the federal government. This has included over $3 trillion in fiscal stimulus. I'd like to highlight a couple areas on this chart as I think they're directly applicable to alternative investments. First, the unemployment insurance expansion, which should help support REITs that hold residential assets, including multifamily, single-family rentals, and manufactured home properties, as those experiencing job losses will have some support to assist their household expenses, including rent payments. Second, the small business loans and grants, which hopefully will provide bridge support for businesses struggling in the midst of the shutdown. Attendantly, this should help support commercial real estate enterprises and BDCs as businesses that are recipients of this government support include consumer-facing businesses and non-essential businesses that have had to impair their operations, and that they'll have access to some amount of credit to kind of bridge them through this economic hardship. Similar to the federal government stimulus response, there has also been an unprecedented policy response from the Federal Reserve to help support the economy. The Fed has definitely signaled that it is willing to do whatever it takes to support the status quo in the face of staggering job losses and historically unique demand destruction. A few areas on this chart that I would like to highlight include the Paycheck Protection Program, which allows businesses to obtain financing designed to preclude additional job losses. Again, this is more support available to businesses, many of which are commercial real estate tenants and borrowers from BDCs. Additionally, the intended beneficiaries of this, employees who otherwise would likely have had their jobs under threat, this will help them meet their household expense burdens. Other areas on this chart that I would highlight related to alternatives include the commercial paper funding, the primary and secondary corporate credit, and the term asset-backed securities facilities. These programs are all designed to provide liquidity in the credit markets, including the commercial mortgage-backed securities markets and corporate credit markets, including junk bonds. These have all been volatile these markets have all been volatile in the beginning phases of the shelter-in-place orders and the spread of the coronavirus outbreak. Again, it's very important to emphasize that this is unprecedented policy action from the Federal Reserve. Historically, they've only been involved in treasuries and mortgage-backed securities. So the expansion to support the broader corporate credit markets and commercial lending markets is truly unprecedented. These policy measures have helped to stabilize equity markets and arrest the plummeting and seizing up in credit markets in light of the closing of the broader American economy. What unintended consequences arise from these policy measures remain to be seen, but at present, volatility has decreased and credit is beginning to flow again. I saw that the VIX was in the mid 30s range. It had spiked over 30, or over 60, excuse me, earlier in the beginning of April. It's important to note that we're probably entering a period with some broad increases in volatility over a longer term horizon. If you go back to the financial crisis from September of 2008 to March of 2009 at the bottom, that you have during that period from the Lehman bankruptcy to the bottom of the market, the VIX was pretty much over 30 perpetually throughout that period. So one would anticipate continued increases in volatility. But overall, the accommodating monetary and fiscal policy from the federal government and the Federal Reserve has provided a very solid backdrop for the alternatives investment industry as credit is made increasingly available and backstopped by the Federal Reserve, and the federal government continues to inject stimulus into American businesses and directly into American consumers' pockets. All of these developments should provide some measure of support for credit markets for BDCs and commercial real estate tenants for large swaths of the REIT markets. As we all know, the publicly traded equities markets were extremely volatile in March and April, reminding many of some of the darkest days of 2008. Publicly traded REITs were not spared in this volatility. As the chart above highlights, publicly traded REIT sectors have generally traded below consensus NAV per share as reported by S&P Capital IQ. The lone bright spot during this period has been the data center and wireless infrastructure REITs. Regional malls have unsurprisingly continued to be hammered in light of this. This is really just more dislocation related to a multi-year trend for the sector. As malls have closed, this has forced a number of retail tenants, including J.Crew, Gap, and JCPenney to contemplate bankruptcy. I just saw that J.Crew did file yesterday. Many of these retailers have been struggling in the face of shifting consumer trends and increasing competition from digitally native direct-to-consumer companies. So this is kind of, some analysts are anticipating that this might be kind of the nail in the coffin for a number of tenants of a lot of these regional malls as well. I think a couple other sectors that are worth looking at here is the office property sector. Millions around the world are telecommuting right now. There's doubtlessly been some reflection in many companies related to what the size or what an optimal size of their office footprint might be in light of kind of some of the familiarity with telecommuting, and many have reported that there have not been significant decreases in productivity related to it. So I think that there's some reason to suggest that there could be some serious secular headwinds for office sector real estate in over in the future. It's also important to note that the data above is reporting only on equity REITs, and mortgage REITs have been in a very tough spot over the past couple of months. Part of this is related to mortgage REITs had an affinity for financing via repurchase agreements, and these repos have resulted in margin calls as evaluations of commercial mortgage-backed securities have taken a hit in late March and into early April. Many of these mortgage REITs were forced to sell portfolio assets into a distressed market to meet margin calls from their repurchase counterparties. Consequently, in March and April, 9 publicly traded mortgage REITs have suspended their dividends. Another 11 announced dividend cuts ranging from 8 to 95% of their previous distribution amounts. And some of these REITs have also shifted dividend payments from all cash to a combination of cash and stock or solely in stock. It's also important to note, as previously mentioned, that a number of the Fed's policies specifically related to stabilizing the commercial mortgage-backed securities markets have helped to shore up this space, but there's still been a lot of carnage related to the equity prices of the mortgage REITs as well. Next, I'd like to move on to some data related to rent collection at equity REITs. This slide features data compiled from the S&P Capital IQ. It is important to note that the data on April rents collected has been coming in from multiple sources, and there have been some time delays. Some of this data is as of the first or second week of April, so it may skew a little bit lower. And again, it's not a complete data set related to the market, but it definitely is the best information. This and the NAREIT data that I'll go over is the best information that we have at present to go by. So a couple of highlights from this. The multifamily sector appears to be holding up pretty well, with 5 REITs reporting they've collected 94% of their April rents. One interesting thing to note related to this is that many of the publicly traded REITs tend to gravitate towards more and newer Class A properties as a part of the composition of their portfolios. These Class A products might be a little bit more resilient at this early stage of the crisis, given that rents at these properties tend to be a little bit higher and the tenants are more likely to be in white-collar occupations. These white-collar jobs have not experienced the same level of job losses as many service sector jobs, including folks working at restaurants, bars, or hair salons. Encouragingly, manufactured housing REITs have also reported some strong rent collection as well. Perhaps this could be attributable to some of the fiscal stimulus aimed directly at American consumers. However, it's still pretty early, and any broad conclusions drawn from the April rents, I think, might be a little bit premature. I think it's really important to look at what the May and what the June rent numbers are going to look like. I think the Q2 data is really where we're going to get a much more cogent view of what the economic fallout related to the pandemic and the shelter-in-place orders are going to look like for the commercial real estate and space going forward. Another area to focus on here is student housing as well. While the data here is quite slim with only 1 REIT reporting, there's definitely some concern and a lot of conflicting information as to what extent schools will be open, what extent colleges and universities will be taking students in the fall, and what enrollment might look like at those colleges and universities. Again, if there are any significant disruptions related to the timing of that or decision making from individual universities, this would likely have material consequences for a number of the student housing REITs. Again, time will tell, but the Q2 and Q3 data is going to be the most important related to that specific subsector. Again, this slide features a summary of April rent data from NAREIT. NAREIT conducted a survey of over 50 publicly traded REITs with over $400 billion in market capitalization. This data is equity market cap weighted, so it may skew towards some of the larger respondents in the survey. A couple of key takeaways include that the shopping center data largely corresponds to grocery anchored retail. There are some interesting dynamics within this subsector. During the outbreak, grocery anchors themselves have experienced some of the strongest demand they have historically, as restaurant traffic has plummeted. A lot of the chatter that I've heard on earnings calls at publicly traded REITs has yielded the insight that many of these grocery anchors are paying rent in full. The same with a number of the pharmacies that likewise are enjoying robust business during the pandemic. Really, the deterioration in the performance of this sector is much more attributable to the peripheral kind of mom and pop tenants, if you will, the restaurants that are having diminished performance as they're not able to take dine-ins, or dry cleaners or hair salons. Really, a lot of the service-oriented economy that is deemed non-essential or subject to shifting consumer trends related to concerns about health and safety. It's also important to note that regarding the healthcare sector, rents that are reported here at about 86%. NAREIT data highlights that medical office buildings are experiencing declines in April rent payments. We've seen this from a number of sponsors in this space as well. Medical office buildings tend to have tenants that include specialty physician practices or outpatient surgery centers, and many elective and preventative healthcare and diagnostic healthcare companies have had significant disruptions to their businesses in light of the pandemic. Senior housing and skilled nursing payments appear to be holding up a little bit better in the current environment. NAREIT also, they did not release data on regional malls or single tenant net lease. They didn't receive enough responses. However, they did comment that the limited data suggested that rents at malls was lower than that reported here for the shopping centers, and that single tenant rents were a little bit higher than reported here in the shopping centers. Again, the May and June data is going to be key to understanding kind of the longer term effects within the commercial real estate space. So next, we'd like to cover some of the major responses that we've seen in non-traded REITs related to the pandemic. First off, there have been reductions in shareholder liquidity. Many programs have either restricted or suspended their shareholder redemption programs related to the deteriorating economic environment and kind of concerns related to the validity of some of the net asset values that some of these REITs have struck. I mean, if you're a 1502 compliant REIT, you struck NAV once, and that may have occurred back in December of 2019, or it may have been as of December 2019, and it may not be incorporating some of the economic realities that are being experienced now. Other things that we've noticed have been reviews of distribution policies. This has included reductions in distributions at a number of REITs, delaying distribution declarations, increasing the frequency with which distributions are declared. That last one, increasing the frequency, allows the REITs greater flexibility to kind of respond in real time as they get more information related to their underlying rent collection and operating performance. Again, distribution reinvestment suspension, we noted on that as well, that there are certain reasons to be concerned that some of the NAVs that may be a little bit stale need to be updated related to kind of the current economic conditions that are experienced. Obviously, there's a lot of uncertainty in the market. There's a lot of volatility in publicly traded markets, and there's been a decline in transaction volume in commercial real estate as well. So this is going to take some time, we anticipate, for this to kind of play out, to get a little bit more confidence related to a number of the valuations and net asset values per share. It's important to note that we've seen a couple of REITs that have explicitly noted that their NAVs are not to be relied on in light of the deterioration of economic conditions subsequent to the date of the NAV. Other major developments that we've seen have kind of been managing balance sheet liquidity. This includes a number of REITs, both non-traded and publicly traded, to draw down all or a significant portion of their revolving credit facilities. This is designed to help them ensure that they have the cash and the balance sheet liquidity to kind of make it through this period of uncertainty. A couple of key things will be to look at the Q1 numbers to see to what extent this increases the overall leverage of a number of these REITs. As we mentioned, a number of REITs are looking at working with their lenders to prospectively restructure debts. We've seen this most acutely in the hospitality space. Many of these REITs have been reporting that they have been finding lenders are accommodating in suspending interest coverage requirements, delaying principal and interest payments, and a willingness to extend out debt maturities. Some lenders have not. It's kind of a case-by-case basis. It's something that we're trying to stay on top of here at FactRight, and we report this information out in our weekly updates that I hope you subscribe to. And if you don't, please reach out. We'd be glad to help get you set up with our weekly updates as well. It's also important to note that a number of the hospitality REITs have also filed current reports indicating that they're still working with their lenders to try and modify existing loans, and some have even disclosed that there's a possibility of foreclosure in the future on certain properties, and some have even indicated that they may strategically hand properties back to the lenders in order to try and reduce REIT level expenses to try and preserve more viable properties within their portfolio. Additionally, many REITs have also been reporting that they are actively working with their tenants to try to bridge through this current period of hardship. This includes rent abatement and deferral programs designed to allow tenants to accrue rent and pay it back to the REIT over longer periods of time. Some of the largest publicly traded REITs have reported that they are actively working hand in hand with their tenants to help the tenants avail themselves of various federal programs designed to help support their underlying business, which in turn should benefit the REIT landlord as well. Some REITs have also noted, notably Camden Property Trust, that they are conducting virtual tours of vacant units so that basically it's self-guided prospective tenant tours. This is something that a couple of REITs have noted that they're looking at prospectively doing, and this crisis has definitely fostered that innovation. So there may be some longer-term cost-cutting and innovations related to real estate management that we may see come out of this, and certain best practices emerge as well. One additional note on that lease modification and rent abatement note. The Financial Accounting Standards Board has provided some guidance in the last month on accounting for landlords that provide relief to tenants to mitigate the economic effects of COVID-19. If this relief includes lease deferrals, payment forgiveness, or reductions in future lease payments, the guidance notes that the landlords can effectively punt on deciding whether or not that concession would be a lease modification, provided that the concession does not result in any a substantial increase in the rights of the landlord or the obligations of the tenant. FASB did note that landlords should consider whether disclosure requirements under GAAP accounting to allow investors to understand the nature and financial effect of any material rent relief provided to tenants or granted related to the COVID-19 pandemic. So basically what we anticipate coming out of this guidance from FASB is that REITs that do offer concessions to tenants, they may not classify it as a lease modification which also requires certain accounting provisions to be made, but there will be likely an increase in the amount of footnotes related to existing leases outstanding. So this is going to be something that we're looking forward to in the Q1 and Q2 financials that will be reported in the next couple of weeks and couple of months. But there's likely to be significant color related to a number of these changes that have been made to leases that under the guidance won't qualify as, or won't be required to be reported as a lease modification. Other trends that we've seen have included reductions or suspensions of capital expenditures on existing development projects. And additionally, many of the NAV REITs out there are beginning to reduce the frequency with which they are reporting their NAVs. This is completely understandable, again, given the volatility in markets and kind of the uncertainty related to tenants' ability or willingness to pay rents in certain instances. So these are a few of the broad trends that are emerging in the REIT space. Doubtlessly, as more data becomes available, we'll be staying on top of it and providing you with updates so you can understand what's occurring with a lot of these non-traded REIT programs as well. I think overall it's fair to say that most of the actions that we're seeing taken by non-traded REITs on a high level are designed to enhance balance sheet liquidity, restructure the liability side of the balance sheet, and actively work with tenants to kind of proactively plan through this hardship as best as possible. All of these things are designed to preserve shareholder value in the long run, even if some of these measures are very difficult for shareholders to stomach in the short run. Further reductions on shareholder liquidity is obviously not ideal. I think there's some unique aspects related to the market that in certain uncertainty related to tenant payments and the lack of transactions that it may be prudent to do that for the short run. Hopefully it remains only in the short run and that things can start getting back to normal. Likewise, distribution suspensions and reductions are obviously not ideal as well. And hopefully as if tenants are able to resume their business and continue to make rent payments, that will kind of turn itself around in short order. Again, how successful these efforts related to preserving shareholder value are going to be in the long run, that remains to be seen. So next, I'd like to show some data that we've produced and that's available for you to download on the FactRight Report Center regarding non-traded REIT liquidity. This data set is designed to be a quick reference related to liquidity on non-traded REITs specifically. First off, this data includes, as you can see from the fourth column from the left, some information related to total leverage on the REITs, debt to total assets, debt to gross properties, as well as some information related to what percentage of the REITs outstanding debts are coming due in 2020 and 2021. as well as some information a little bit further to the right related to liquidity available to meet these debt burdens. It's important to note that liquidity available to current debt, the fifth column from the right, this takes into consideration the unrestricted cash and cash equivalents plus any amounts that are available and undrawn on established credit facilities. As we noted earlier in this presentation, many of the constituent REITs in the past 4 months have drawn down either all or a substantial portion of the amounts that they've had available on revolving credit facilities. So as this data is as of December 31st, 2019, the Q1 data is going to be much more inclusive of some of these changes. And as noted, as those draws are made, it's going to be important to see where the overall leverage of a number of these REITs perhaps migrates a little bit up as they try and put more cash onto the balance sheet to preserve some liquidity. Another note, the two columns on the far right are designed to present users with a glimpse as to how much of a reduction in EBITDA is needed for EBITDA to equal the interest expense and preferred share dividends of each respective REIT. So essentially, how much does EBITDA need to decline for that interest coverage ratio to equal 100%? Similarly, the column on the farthest to the right is a percentage reduction of top line revenue for EBITDA to decline to 100%. Again, it's important to note that that metric assumes that the REIT is unable to, it assumes that the expense side is static for the respective REIT. As we all know, many REITs have been aggressively cutting costs in light of the outbreak. So as additional data becomes available in Q1 or Q2, I think there's going to be a little bit more clarity regarding some of those metrics in the liquidity report. We'll make this data available as well as we get the Q1 information in the next couple of weeks. So let's take a look a little bit at one of these constituent REITs that we have here. And in the table on the bottom of the page, we have Hospitality Investors Trust. As you can see here, this REIT has had a really challenging road. It's in the hotel industry. It's had some aggressive leverage historically with debt to total assets of over 70%. It has significant operational challenges in light of current market conditions. It's been reporting via current reports that it began experiencing softening demand in early March of 2020. Hospitality Investors Trust has also noted that they've reached out to a number of their lenders related to restructuring debts that are coming due in 2020. They have a very substantial portion of approximately $240 million worth of debt that's coming due by the end of the year. So far, it has not reported that it has been able to successfully restructure that debt. It's looking at possible ways of extending it or refinancing out that debt. The REIT has also noted that its NAV per share of $8.35 per share as of December 31st, 2019 should not be relied upon in light of the economic effects of the COVID outbreak. So there are a number of important developments that are going to occur with this REIT over the next couple of months. We'll continue to report on this in our weekly updates on Thursdays and Fridays. Again, I'd encourage you, if you're not receiving those, to reach out to us and we'll get you signed up so you can kind of stay on top of in relative real time some of the developments that are occurring with a number of these REITs. A little bit related to this chart again, it's important to note that this data is sourced from S&P Capital IQ. S&P Capital's IQ reporting may vary slightly from the data reported in certain tables and disclosed in writing by some of the REITs in their annual reports and quarterly supplements. So there may be a little bit of a delta related to some of these metrics from what you're seeing in earnings snapshots from some of the constituent REITs as well. This data is highlighting two different sectors, the diversified and hospitality sector. We also have these charts available in our supplement for download for healthcare, office, multifamily, and more niche real estate sectors as well. I believe we'll be really emailing out a link to obtain this data and a summary of the last 2 months worth of the weekly updates for listeners on this webcast or webinar. Next, let's move into a little bit of some of the developments in the BDC space. First, publicly traded BDCs have experienced significant turbulence in light of the COVID-19 outbreak. There's been a massive sell-off in the publicly traded BDC market. This followed a period in late 2019 and into early 2020 in which publicly traded BDCs seem to have found a little bit greater favor on the street with about half of the 40 publicly traded BDCs at that time trading at NAV or greater. I checked recently and the mean price to NAV of publicly traded BDCs was 0.6x, indicating that the average BDC is trading at approximately 60 cents on its reported dollar of NAV. This surely does not bode well for prospective liquidity events for some of these legacy non-traded BDCs. It's also important to note that BDCs have been quicker than many non-traded REITs to adjust their net asset values per share in light of kind of the challenging economic environment. BDCs typically have policies to adjust NAV if it moves up or down by 2.5% or more to prevent shares from being issued above or below, shares from being issued in their distribution reinvestment plans from being issued at values too high or low relative to their NAV to prevent dilution and to be fair to the investors in the program. This NAV erosion in many instances has tracked deterioration related to the S&P LSTA index, which tracks broadly syndicated leveraged loan prices. This is generally the best proxy that we can find for a lot of the private equity sponsored loans that are kind of the bread and butter of the majority of the non-traded BDCs. However, it is important to note that while this index has kind of been battered over the last couple of months, the policy response from the government is designed to provide as accommodating of a backdrop as possible for credit markets. Just saw in the past week, one BDC is actually, in light of a little bit of buoyancy in the LSTA index, has actually reported an increase in net asset value per share in late April. BDCs have also been quick to modify distributions, with at least 4 non-traded BDCs suspending distributions in the past 2 months, while some others have also reduced distributions. Still very early related to the economic fallout of the pandemic, but it's really important to be focused on where default rates in the leveraged loan space are going to be in the future. And S&P and Fitch's have both reported that default activity picked up in April of 2020, with April 2020 defaults equaling the defaults in all of Q1 2020. Additionally, Fitch is forecasting leveraged loan defaults to increase significantly in the next 1 to 2 years. They anticipate the leveraged loan default rate may rise to 5 to 6% in 2020 and 8 to 9% in 2021. For a little bit of context related to that, the historical leveraged loan default rate has kind of been around 2.5% for a number of years. In early 2020, this rate was at 2.1%. So again, that's an area that we're acutely focused on, is where default rates in the market are going to be and how is that going to play out as far as non-accruals and defaults and PIK interest in respective BDCs as well. So with that, I'd like to remind you that we are actively reporting on material developments related to publicly reporting REITs, BDCs, and interval funds. We send out this weekly update on Thursdays and Fridays, recapping material events that we think are fit to print. We also provide commentary on developments related to regulation, markets, industry sectors, and publicly traded alternative investment programs, and more. And as I mentioned, we've put together 2 resources for your reference today. These include a broader REIT liquidity supplement for your reference, as well as a compilation of the last 2 months worth of weekly updates, which includes a lot of very detailed information, as you can see here, related to specific REIT and BDC programs and kind of some of the responses to the COVID-19 outbreak. It's also important to note that we have research supplements available on many of these programs on our report center at FactRightReportCenter.com. And we also have additional research supplements that you won't be able to obtain through the report center that are available to our FR risk management clients And if you're interested in understanding how you can obtain those research supplements or interaction with your investment committee, please feel free to reach out to myself, Gail Schneck, or John Pagliata. We'd be happy to assist you in getting additional research and in helping you kind of navigate through this landscape within the alternative investment area. Again, I would also encourage you, if you have any questions related to any of these BDCs or REITs, to reach out to us. We'd be happy to discuss with you as well. So with that, I think I've taken plenty of your time right now, and I see we have a couple of questions, and I will be following up with you folks individually. So again, if you have any questions, please feel free to reach out, and I'd be happy to respond to you. With that, thanks again for attending, and we really appreciate it. Bye.